Thank you for joining us today. Last week, there was some big news around Qubic, the so-called AI-focused blockchain project that carried out a 51% on Monero. There's a lot of questions about whether this is the end of proof of work going around in social media, and they're also targeting Doge, Casper, and Zcash, and I believe the next target actually is Doge, which is sort of funny because Doge was a joke in the first place, and it only stopped being a joke when lots of grifters turned it into a number go up baby to Bitcoin. With the concern, as I say, is that this is going to mean that all the proof of work modules don't work. Fundamentally, our argument and the argument of other people who believe in the proof of work idea is that this is the only way you can truly have a blockchain in which you can trust the message, not the messenger, securely at scale. So we have a lot of differences in how we've approached this. For one thing, we're not an ASIC focused blockchain. We're using the cuckoo cycle, but there are other aspects to this as well. For example, something that we patented and are licensing to the chain under GPL3 laws, so it's completely free for everyone to use, is witnessing. And the architect of that is here with us today. So Ulf, over to you.
Okay. Yeah, so proof of, or these 51% attacks are kind of interesting. So I guess what I want to do is partly explain how they are done and also how we protect against that. And then I think we can also talk about some things around it. One of the problems when an attack like this happens on a blockchain is that law enforcement typically isn't interested because what was really attacked, it's not a regulated asset or coin, or it's not really legally recognized activity that's going on, so enforcement becomes difficult. So that is also one way we think we will be protected as we are building a real blockchain for real commercial activity, which puts us legally in a different place and makes it riskier to attack us. But essentially, the pattern of a double spend attack is, at its core, with blockchains, the way you deconflict information on the chain is that essentially longest fork wins. You build a chain where each block is attached to the previous block. And if two blocks come in at the same time that are both valid, because you have two miners, for example, that solve the puzzle at the same time, and the nodes are trying to decide which one to use, essentially you let it play out. And then the rule is the longest fork wins. So if you have more miners on your side and you keep building blocks on one fork, eventually it will pull ahead of the other forks and it will become the main fork. So what an attacker can do is you can, for example, buy some asset, typically via a crypto exchange. And then once that has been confirmed on chain, you can have an alternative history. Essentially, you are on the side, you're not publishing it, you're just building an alternative continuation of the blockchain where that transaction you made, the purchase you made, isn't there. So essentially you unspend what you just paid for. And then you keep building that block until you've pulled ahead a little bit of the main fork, and then you publish your blocks to the other nodes. And this is a weakness of algorithmic consensus, you might say. All the nodes just programmatically will switch to the longer fork. It doesn't matter if you as a node owner feel that, okay, we're under attack, that's the evil fork, your node is still going to switch to it. And it's really, really difficult to protect against. But one part of this is that you don't know that the attack is happening because the attacker is building their fork on the side, uh, and only essentially revealing it once it has already won. So that makes it really hard to protect against. So one of the things that makes this possible is that essentially a transaction doesn't become final on a chain like Bitcoin until you feel that enough blocks have been built on top that it's going to be prohibitively expensive to switch over. Now, prohibitively expensive means that you're going to have to beat or become the most powerful miner for quite a while. And one thing that Qubic did that was a little bit novel was that they actually bribed like 28% of the existing Monero miner base to come over to their side and join the attack. And then they only had to add about 5% on top of that, and which makes not 51%, probably 35%. But since you can just basically sit there and play the numbers on the side until you've been able to pull ahead with only a few blocks, this can take a few hours. You can actually do it with less than 51%. Like if you control 51% of the mining power, you are guaranteed to be able to do this. But you can actually do it statistically with less. So how come they bribed the miners? How could that happen? Well, most people who mine on blockchains do it because it's a way to make money. So they're just in it for the money. And if the attacker pays you more, then yeah, why not? Greg, did you want to
Yeah,
say something?
sorry. That's also a strength because the whole point of a proof of work is that everybody is motivated to act in their own best interests, and it is trusting that they will do that that allows us to trust the message, not the messenger, securely at scale. Now, there are different incentives when you have real money that really works, because now there's an incentive for people using the network to mine defensively. But ultimately, what Qubic have done here is they've taken something that is at the bedrock of proof of work, which is that the miners are chasing the solution, that everybody is competing. And essentially, well, whether they've threatened it or not is another question. Whether they have sufficient computational capacity to really fork. I mean, as you pointed out, what percentage did they actually manage to get hold of?
Uh, According to one article, we've seen about 35%, something like that.
Okay. Which is interesting because, you know, Bitcoin, 95% of all Bitcoin is mined by 5 accounts. Over 51% is mined by 2. So how far off are we from that? And Larry Fink's comment that uh, I think the words were, there is no guarantee that Bitcoin's 21 million supply cap won't be changed in the future. In other words, once they have sufficiency of mining power and control, they can begin to fork and change things.
So, yeah, and also what we've seen among Bitcoin mining pools is that miners who join mining pools are essentially just going for the one that pays the best or gives the most perks on the side. So you can
Sorry.
definitely
Talk about that a
stage
bit
an
more
attack if you want
because
to by being the most attractive mining pool out there. And once you've attracted enough miners, you can do your thing.
sorry, a lot of people won't know about that. I didn't know about that until you guys were talking about it the other day, that there are a lot of incentives given to miners that aren't actually straightforward mining returns, and it becomes a little bit cagey and odd, well, a little bit odd, I would have thought, from a regulatory perspective as to what's really happening.
Yes, and so this is apparently there is some rumbling about whether mining pools should be regulated. And one reason is that the mining pools on the Bitcoin side especially are much more than just mining pools. They try to essentially partner up with the miners and often offer various discounts and exchange services and all kinds of stuff that are beyond mining. And then you can get into murky regulatory areas where you're not just joining a compute cloud anymore. It's more involved than that. And part of it is because the competition is fierce for the miners. And again, the miners are only in it for the money. There is no other reason to mine, essentially, unless you're a Bitcoin altruist and you really, really care about the chain and you feel that there should be good miners out there as well, not just, well, I mean, greedy miners are not necessarily bad. They've just found a way to make money. But that also means that if the bad guys pay more, then they may actually succeed in doing kind of what Qubic did. Now, this is a problem for a lot of blockchains in general, that if, for example, the price of their coin goes down, miners may feel that they can make more money on a different chain, and they will just start mining for another chain. Also, blockchains that get delisted by exchanges, then miners may feel that, yeah, it basically pays well, at least on paper, but it's really hard to sell the rewards that I'm getting because there aren't enough outlets, or if there is not enough traffic on the chain or not enough traffic around the coin, miners may feel that as soon as they try to sell their mining rewards, they will drive the price down. Because you're muted, Craig.
Sorry, I've got a little bit of a cold, so I keep trying to mute to stop people from hearing me splutter and cough. This feeds into something that you've been talking about a fair bit, which is this whole aspect of defensive mining. And actually, when you look at Bitcoin, there are an awful lot of people mining it. Now, they are doing so without any hope of ever winning in reality. The mathematical chances of them winning versus the big guys is infinitesimally small. What they're trying to do is provide a sort of a backup to the whole thing, because they are believers in what Bitcoin was supposed to be, which we argue is what the Gaju actually is. So defensive mining, you've spoken about it a little bit in the past in different contexts. Would you just like to give a little introduction to that with a bit more detail? And then I'd really like to get Craig talking about the utilization, because you spoke about how coins are being, how the incentive comes from mining the coin, but then what do you do with the coin? And this is one of the things that we really wanted to do from the very beginning, was to say, well, it's money. So what do you do with money? You trade with it, you buy things with it, you interact. What's it worth? What's its buying power is the correct answer to that question. So just to get into the defensive mining point and how, let's really expand the two things, the defensive mining on the one side and how we are very different, what the witnessing module should do to help foster greater security, and also settlement times, which will feed across to Craig.
Yeah, so defensive mining is actually, well, it's essentially one of the things, if you start thinking what would happen if you managed to build a blockchain that actually works as money, where real businesses can come in and do commercial activity on the chain. So if, say, you're a restaurant and you're offering your customers to pay in Gajus. We happen to have a prototype restaurant website where you could do just that. Now, what would you do as a restaurant owner to protect your investment, the commitment you've made to operating on this market? Well, one thing you could do is you could join, for example, a mining pool and add some mining capacity to a miner you trust. And a mining pool you trust could be a miner that actually operates in a regulated space where they commit to their customers that they will do fair mining, which actually is a contractual obligation which you can sue them for if they stray away from that. But essentially, a defensive miner is one who feels that they can spend some money on mining to stabilize the chain because their business depends on the chain. They have actually invested part of their business in doing real commercial activity on the chain. So then defensive mining becomes a security. You invest in the robustness of the chain to protect your business case, because the business case is not just the price of the coin.
No, what they're really looking at is if we start talking about people shifting to a digital economy that's built on blockchain, which is what the whole point was supposed to be, then everybody who's using that network has an incentive to make sure that network stays robust, stays straight, as it were. And that is at its heart what you mean by defensive mining, is that somebody who doesn't have a realistic, so 10 years from now, when the competition to mine on the Gajumaru is a lot higher than it is now, somebody with a basic computer isn't going to pick up many, if any, Gajus from winning a puzzle, winning a race against much more powerful machines. But there is an incentive, regardless, for them to leave that machine running and let it continue to work, if only because it's providing that defensive capacity that actually hard forking the network becomes really difficult. But there's a bigger innovation than that in what we've done, which is the patent on witnessing that you're the architect of.
Yeah, so witnessing, I mean, it's in some sense similar to validator pools that other blockchains have. But so what we do is the witnesses essentially sit and observe what block is the next block on the chain they're following. So if a block comes in and you validate that and say this is a valid block and it is actually following what I felt was the top block on my chain, then you can sign a testimony saying this block looks good to me. It actually, it's not competing with my fork, it is my new top. And if a majority of the witnesses testify to a certain block being a good new top block, that means that, well, the miners working on the next block will include those testimonies in their block candidate. So once a new block is produced that contains a majority list of testimonies, then that preceding block is sealed onto the chain and cannot be evicted. Now, this has a few advantages. One thing that this signals is that there is a possible error condition where, due to network errors, nodes get isolated from each other. They get cut off from each other. Happens frequently if you have nodes in China, for example, because of their great firewall. And if your node is following a chain that's on a minority island, it's not connected to the main fork, essentially, and you don't know this because you're isolated, this witnessing algorithm will actually give you a signal, because you see that your blocks are not receiving a majority from the witnesses. So that becomes an immediate signal that you may want to look into whether there is a network error. So the way it typically works out is you see a block, a new key block on the chain, and immediately, within a second, you will see a majority of testimonies, which in our Explorer, for example, will indicate that this block is on its path to finality. It's already been seen and approved by a majority of the witnesses. So my expectation is that the next key block will seal this block on the chain. This means that typically key blocks are 2 minutes apart. So within 2 to 4 minutes, typically your transaction will be finalized on chain and cannot be evicted. So if you have a high value transaction, for example, you're buying a Ferrari or your new Lambo with a blockchain transaction, typically after 4 minutes, you will know that that transaction isn't going anywhere, cannot be attacked. And if you don't get that signal, then you may want to wait longer until whatever is going on with the network has healed itself. So this gives a lot of security when you are, especially when you're doing cross-chain transfers, because you can actually know for a fact that a transaction is completely secure on the chain before you move on to the next step. Now, for an attacker, this means that if you want to stage a brute force attack, you have only a few minutes to do it. Now, Qubic was sort of lazily mining for, well, not lazily, but they were mining for a few hours until they were able to essentially do a 6-block attack, where they could post 6 blocks on the chain that were sort of their fork. And so this would have, if you want to attack Gajumaru on that way, you'd have to compress it so that you stage enough mining capacity that you can win the next block. But it's not going to be likely to fool anyone, except if, I mean, again, if you buy something expensive from somebody and they know how the chain works, they're going to wait for finality, because finality is going to happen very quickly. So they're not going to send you the gold or whatever that you bought until the transaction is final on the chain. So then the attack is not possible. So then you'd have to do a whole bunch of low value transactions, perhaps, that are so low that people don't worry about. They may look at the witnessing and feel that, no, it's going to be fine. I don't have to wait the 2 to 4 minutes to see that this is guaranteed on chain. And then you strike as an attacker, but you're going to have to outmine the chain with more than 50% probably to be sure that it's worthwhile, that the odds of beating the chain with the next block is actually going to work. So it's drastically going to increase the amount of effort you have to put in, because the attack window is so small. And if you couple that with defensive mining, yes.
Whenever you buy something with Bitcoin, which usually is just other cryptocurrencies, but often exchanges will make you wait a certain number of confirmations. And this is why, is because in the traditional, like as defined in the white paper, Bitcoin, the only security is that the chain has got so long since your transaction that it would be really hard to attack it with a 51% attack. Whereas when you have finality, you don't need to wait 100 blocks and then say, wow, it would be really hard to attack that. You just say, it's signed by all the witnesses, so it's done, and this money belongs to this person forever now. Which is a strategy that is become more common in the proof of stake world, because you don't need proof of work to prove the legitimacy of your signatures. So it becomes possible to sign off on more arbitrary things like this is the top block. And what's really unique in Gajumaru is the specific combination of having the chain itself be a proof of work currency, but still having finality that typically is assumed to be more of a proof of stake thing.
Yeah, and there are a lot of chains nowadays that have some kind of validator logic that claim that they can achieve finality in seconds. One of the control questions for them could be, how do you treat net splits? Because typically a net split cannot even be detected reliably within seconds. Because what often happens is that, well, as a lot of people know, if you lose contact with a website or whatever, often what happens is nothing happens for quite a while, and then timers start timing out or whatever, and say within 30 seconds or possibly longer, you can get an indication that the other side isn't responding. And you don't really know why. You don't know if you're isolated from the network or if the other side. This is essentially a pathological problem also for distributed databases. And the really hard part is recovering from it afterwards. So one thing is, if you declare finality really quickly, and then a net split happens, or you declare a finality and you're on a minority island, so you didn't even know that you were isolated, and then the network heals and your previously final transaction is evicted because there were other final transactions on the other island that that won out. So finality becomes really hard to guarantee in the face of net splits. So Algorand is one blockchain that at least addresses this in documentation. And what they do is, if they detect a net split, they will stop the chain. They will not accept any more transactions until the net split has been healed. Now, this is a viable way to solve it by some definition of viable.
If you control the chain, which to a large extent proves that actually they are operating the chain. This is what we keep talking about, is that once you have governance, you're not a resource layer, you're an infrastructure.
So you can do it programmatically, but I mean, this does speak to another issue, is like what we've been talking about, the trilemmas and the cap theorem when it comes to databases, like consistency, availability, and partition tolerance. This is what the cap theorem is. You need all three. Typically, you can only guarantee two of them at any given time. So in this case, for example, you sacrifice availability for partition tolerance. You've noticed that an error occurs and automatically all the nodes just essentially stop processing new transactions until they are in contact with each other. So it could be done in a decentralized way or in a centralized way, but for the user of the chain, it means that everything will just stop, which is typically bad. Now, this is something that our witnessing solution enforces the assumption that the real fork is the island, if there is a net split, that has the majority of witnesses. If you don't achieve majority of testimonies, then finality is not guaranteed. So then activity can continue. Now, if enough witnesses are offline that you cannot reach majority for that reason, then you will see that witness finality doesn't occur, and the fallback is longest fork wins, as normal for proof of work. So we have availability as well. The chain will continue to operate. It will just essentially flag to users that you need to be a little bit more careful now. So, Craig, if you're speaking, you're muted. And a final thing about the way this works in Gajumaru is that since we're using Bitcoin NG, the blocks that are mined are called key blocks. They have no transactions in them. So the witnesses only testify to the key block being a proper successor of the top block on their chain. It doesn't conflate transaction selection with validation. In some other chains, you essentially have a validator pool where they take turns producing blocks with transactions in them and then validating each other's work, which to me introduces the risk of collusion, that you're not just validating that a block follows the rules, you're also validating the content, even if you say that, no, I'm not looking at the content. In fact, you are. Or, I mean, you could close your eyes, but you put your stamp of approval on the block. So you have de facto approved the content selection as well. So in the case of Bitcoin NG, the blocks you validate have no content in them. They are just structural. So it's a purely structural validation, which I think is also quite a nice feature, actually, from a liability point of view. So we have fast finality, at least fast enough that it's really hard to see that brute force attacks are gonna work or be profitable. There is a useful, commercially useful window for confirmation of a transaction. Like, you only have to wait a few minutes to be 100% sure that the transaction is stable on chain, which means that you can also do high value transactions without having to worry about these attacks and without having to force customers to wait for hours before they can feel safe that, or before you give them confirmation. And with defensive mining, it's going to be really hard to bribe up to 30% of the miner base to switch over to the dark side just because you pay better, because they're not in it for the pay. They're not in it to make a profit on the mining per se. The mining is just the insurance to make sure that the chain stays stable while they are making money on their own business case. So this is a game changer. Now, the other thing I think will matter is that once we start getting regulatory approval on associate chains and you have actual commercial chains, some associate chains run by banks, for example, or whatever, maybe national digital currency chains even, law enforcement is going to pay quite a bit of attention to people trying to attack the integrity even on the root chain. Even if the root chain is not strictly within their jurisdiction, it still affects assets that are. And this will make it, now we've seen, for example, with Tornado Cash recently, that even though that wasn't strictly a regulated activity, law enforcement will still come after them because it does affect things that are.
So this also feeds into this whole point about this being a used currency. And
Yes.
one of the points that I was dragging at earlier on, I would like to push over to Craig because this is something he speaks to very well, is I'll actually just do the screen share and show people what the specific claim is that's being made. So you guys can see this. This is a post from Rowrider. The reason that all the publicly traded Bitcoin mining companies like Mara are scrambling to pivot to AI data centers is because the BTC mining industry is literally cooked. Hash prices in the dirt, Mempool empty, fees never recovering with all transactions either paper trades or Wall Street. Now this touches into what we talked about last week, that Bitcoin is basically being intermediated and it's no longer being used as a currency in any way, shape or form. And you can see the hash price index here and what's been happening to this. Craig, over to you.
Right. So the long-term idea behind Mempool transaction fees. So if I'm going to send money, I'm going to send some Bitcoin to you, Greg. I would have to attach the amount that I'm sending you is in the transaction, and then there's a fee that I pay for the use of that network, and that fee goes to the miners. Some chains have a split. We have a split between current miner and next miner and so on, but regardless, it goes to the miners, and that's to pay them for the act of mining. The idea being that if you have a lot of transactions, then the mempool is saturated, and a saturated mempool now becomes competitive, and the price of those transactions, the transaction fees themselves, will become competitive because the miners will want to pick the most juicy transactions to process first, and so on. So you have a naturally competitive environment for transaction selection that pays miners, and that means the whole reason for this is that over the long term, Bitcoin has made famous this halving moment, right? We have a mining curve that's not entirely unlike that, except we don't do halvings like these big severe drops in reward, but there's still a thing where over time, the block reward component of what miners get is reduced as all the coin eventually gets out into circulation. What's supposed to sustain mining as a profitable enterprise for miners and attract people to it is these mining fees. So those transaction fees, as long as the mempool is really being used, then mining fees should be profitable like forever. But as we just saw with the Bitcoin mempool, that hasn't quite played out. Part of that's because of maybe not the most thought was put into the way that the mining pool or the block reward curve would work over time. Maybe also a little bit of, well, a lot of things about Bitcoin are not fully thought out. It's a proof of concept that got out and, got juiced a little bit too hard. So now for the moment, we seem to sort of be stuck with it. One of the basic problems with Bitcoin is a combination of the transaction delay, where, as Ulf described earlier, what's mined in the puzzle phase of mining is a key block that establishes who the leader is, but the leader after that is mining. They're including transactions from the mempool in microblocks, and that's where the transactions occur. Those transactions have those transaction fees with them. That pays the mining, the group of miners that are making the chain go. Bitcoin only has blocks, and the block has the proof of work and all the transactions included into one thing. And that means before any transaction can be processed at all, you have to wait for the next block. That means that at a minimum, you're waiting a few minutes, if not a few hours, for any transaction to go through. It's a little awkward to be, you put your credit card into the cash register at the shoe store and you wait 10, 15 seconds and then the thing's through, something like that. Not a minute. You wait tens of seconds. It'd be pretty awkward to have to wait several minutes to buy a pair of shoes. And it's incredibly awkward to wait a couple of hours. And that's just to get the thing processed. If you need confirmations, if you're buying something pretty expensive, you need a large tail, like Ulf was talking about, the algorithm picks the longest fork, right? So if there's an attack going on and there's been 4 or 5 blocks already mined, the Qubic attack was 6 blocks at their best. So, and I forget the block time. This was for Monero. I don't remember what the block time for Monero is, but you're looking at however long the block interval is times that many blocks. That in pure proof of work, you have to wait to be confident that the transaction that you saw processed actually went through. So in the Bitcoin case, you would have a transaction that you put in the mempool. You wait for 15 minutes. It finally comes out. Then you got to wait like an hour to get a couple more blocks on top of it to feel comfortable that it's not going to be evicted. That's obviously not useful as money. So in our case, with microblocks and key blocks, so we can have a very quick reaction time for transactions. Low value transactions, when I say low value, something in the realm of $100 or less or something like that. You could pay your restaurant bill and it's just done within 2 or 3 seconds. You get the transaction's already processed. It's on chain already. But that's still open in the sense that there's not a new key block that's capping that generation off. And the reason that capping the generation off thing is important is because when the cap comes in, that's when you start getting the confirmation process. So the witnesses, if you do a high value transaction, you're going to pay for something at several $1,000s. If you pay for it in Gajus, the confirmation comes through right away. It's on chain. You can see it. Then the next generation starts within 2 or 3 minutes and immediately is confirmed. That means you've got confirmations. It's all the witness network already did its thing. That can't be evicted now. You're completely comfortable that this actually went through. If you're doing a high value transaction, you're absolutely willing to wait a couple minutes. If you're doing retail level, low value transactions, that quick response time makes like online purchases super smooth to deal with. And that's just one of the several aspects that sets the Gaju apart from Bitcoin and Ethereum. Just these other things that it's like a speculative, fuzzy notion whether or not your transaction is permanent until you gain some confidence in it. We can guarantee that right away. And even on Groot, not even on AC where they could do anything they want, in terms of like promising you the way transactions went through, or even deferring, making a split between payment and settlement for like a Visa type and fraud prevention thing. Even on the main, the Groot chain itself, where the coin's actually minted, you can do commercial transactions directly right there, and I'm super excited about that. Obviously, I'm the CP, I'm the chief product officer, so I'm all thinking about product stuff all the time, and that's what really I'm excited about right now. And I want to get. This touches on a previous question in the conversation, which is, I've got my cryptocurrency stuff in my, my magical mathematical wallet. What do I do with it now? And we finally have an answer for that with online marketplaces where you can actually spend stuff and pay at the register systems and things like that. That's why I'm so kind of got my focus so hard on wallets, in particular mobile wallets right now. So we have desktop wallets already a thing, mobile wallets that can do, use our grids our grids link system to do things like smart contract signatures and stuff like that, and submit those to the chain, get confirmations back right away. The witness system happens. It's all locked in. That means, hey, we can finally do business online on chain, not intermediated, but like actually on chain, not in somebody else's ledger inside of an exchange or whatever. And we've got, MVP, we have viable product models already for a lot of these things. And this is what I'm excited about, is to push this out, because no one's done this in blockchain yet. So no one's been able to spend cryptocurrency on chain as money in like a normal retail setting yet ever. So I don't know how that's going to change nobody actually knows how that's going to change the cryptocurrency landscape. But it's not going to be the same after this. What we see with Bitcoin, that chart that you just showed with the transaction fees on Bitcoin dropping precipitously, that is the effect of almost all the transactions that are happening. What that post was kind of about. There's a lot of Bitcoin transactions happening, but none of them are happening on chain. All the Bitcoin is held in like a couple of wallets. Most of those wallets are owned by big banks, institutional investors, or exchanges. And inside of those ledgers, so they just like imagine two wallets have all the Bitcoin, and internally they're just keeping their own books on who owns what, and they're making transactions happen, but it's all off chain. Actually, in terms of the practical reality of who owns what,
Hold on, there has been innovation. There's
Sorry?
definitely been innovation. There's definite innovation there. What they've done is they've done a thing called regulatory arbitrage. So they could be an actual bank or an actual exchange, which would be a multilateral trading facility, or a central securities depository, the most heavily regulated entity in the financial services world. They are none of those things.
Right.
So actually, there is no segregation of accounts. So the magic is that they managed to get people to believe that you're doing anything with Bitcoin at all, and that your Bitcoin are safe, because actually they are completely commingled with everybody else's Bitcoin claims and their own. And you then have the questions about rehypothecation, which is where they're lending Bitcoin to other people. And it might be the case, probably is the case, that the commitments to what is there versus the actualities of what's there are different.
Yeah.
And there's no
we may
oversight
have
for that.
reinvented fractional reserve banking on accident. Well, probably accidentally on purpose in some of these cases. Alameda. That the FTX debacle was kind of about this, that there's stuff on chain, and that's really, really on chain for really real. And then there's the kind of wacko exchange proposition, which is give me all your crypto and give me all your fiat, and I pinky swear I'm going to keep track of this. None of it's going to go missing. There's no monkey business. I promise, because I'm a nice guy. So you trust me.
So this is
there's a lot
essentially
of
what
everyone.
we talked about in the last video about how
Yeah.
when
It's
you're
loose back
paying
to
with
that
Bitcoin.
topic.
All of these things are linked. This is the
Yes.
point. All of these things are genuinely linked. And
And
I have more fun with than you guys in a way. It depends upon your definition of fun, because I talk to a lot more crypto people than you do in my daily discourse. And the thing that trips them up, that they don't like it when I say it's an actual blockchain that actually works, minting real money that really works. And by the way, it's the only one that does those things. And it's quite easy to win each one of those points. But the easiest way to win the whole argument is to say, okay, if one of these existed before now, an actual blockchain that actually works, minting real money that really works, what's the very first thing that anybody with a brain would build on such a blockchain? And the answer, of course, is a marketplace. So then my next question is, okay, so point out an on-chain marketplace using cryptocurrency where everything occurs on-chain anywhere in the world, and they can't. So the proof of the point is that we have got exactly that. And in fact, 19 years ago, I was penning the idea for what I then called One Eid and later called Quid Pro Quo. Craig was actually thinking about a similar thing, but he called it Agora. And that is what kind of connected us at an early point was this understanding that blockchain is not about speculation. It is not about any of this nonsense that we see to date. It is fundamentally about being able to trust the message, not the messenger, securely at scale, and therefore enabling peer-to-peer economic operations to occur. It's restoring people's will, sovereignty, rights, their fundamental natural law rights. But Craig, you often say, when you hear me talk about how people have said, oh, where's your ecosystem? And my response is, well, the ecosystem is the human economy. What do you mean by that? Well, do you like having, no, seriously, but this is the conditioning that you're up against. So sometimes, and Peter Santosh talks about this as well, sometimes it's easier to ask them to tell you and then let them come to the same conclusion.
Right.
So do you understand what inflation is? It's the printing of money by the central bank. Do you understand what the Cantillon effect is? Well, it's the thing that all the big institutions as near to the central bank as possible actually benefit from that increased flow of money earlier, and everybody else gets it last. So it's not
Before
uniform.
prices hit.
Right, and this is what I mean when I say that us people are the gearbox, through the reductive gearbox through which inflation, monetary inflation, passes before it gets to consumer price index and producer price index, which is what they tell you on the TV is what inflation is. But actually, it's simply monetary inflation, which, by the way, is going to go wild with stable coins, but we'll talk about that another time. Then you say, okay, so everybody understands that, because everybody does. The number of people I've spoken to who said, it's weird, but my dad he didn't have that good a job. He worked in a factory, or he worked he was a mechanic, a blue collar role, but yet he had a truck. My mom had a station wagon, and we went on holiday twice a year, and we all went to college, and there were 4 of us. Right? So that narrative is there in people's head. Anybody our age knows that's what was true of their parents. Why isn't it true of us, and definitely not true of the generations behind us? Answer: monetary inflation is debasing human capital. So that's part one, and I think people innately get that. Part two is the entire economic fabric today is fractured, fragmented systems with the phrase I like is to say that they're toll bridges operated by trolls. Essentially, they're rent-seeking intermediaries who have control of those platforms, those fragmented, fractured platforms, not just the platforms, but also the interconnectors between those platforms, which makes any transition from one platform or one infrastructure to another very risky and very expensive. So again, high friction, high cost. And I think people innately understand those things. Then you can say to them, okay, so how about we had an economy in which you didn't have those things? Your money is yours, your assets are yours, your data is yours, and you can operate in a completely enabled economic environment where you can transact with who you choose to with the assets that are actually yours and in your control. That I still find, in particularly talking to crypto people, because crypto people are just thinking in terms of number go up, and all they want to think about is, well, what exchange are you on? And you say, we're not on an exchange, but you can buy things with this. You can transact with people. And go back to how eBay grew up. eBay didn't grow by saying, hey, let's take all the shops selling esoteric things and put them online. It came about because Craig wanted to sell a piano, an old piano. It was cluttering up his garage. When he put it on the yard sale for the last 3 years, it never sold because there aren't that many people who want a big piano in their house. So he puts it on eBay and it sells. Does he care that eBay is gouging him between themselves and PayPal for 20 to 40% of the price? No, because he wasn't selling it otherwise. And that's really how eBay grew. It grew about selling secondhand things and becoming a giant yard sale that the whole world could walk past your door for. And I think the same dynamic can occur with Gajumaru. But you're the one
like the initial
who
model.
hammers that point hard. So over to you.
Yeah, that's like the initial model for Gajumaru, the one for one sale item proposition. It's kind of the reverse of the classifieds. Instead of looking for, it's looking to sell, and it's completely on chain. All it does is connect people. Somebody wants to buy a thing with somebody wants to sell a thing. Now the further parts of that go into a more interesting direction, of course, is the Gaju markets. When we put the S on the end, and it starts brand your own shop and all that stuff. But the one-for-one sale, the kind of one-for-one sale propositional idea is really simple to understand. It's a great place to kind of get everyone's feet wet with just the idea of like, oh, I can actually spend the money as money now, because like it's the deprogramming step that has to happen, because people are so caught up in like, what's the new news in the wacko crazy financializer derivatives market that's going to make the number go up again. Like, no, shut up. Like, just don't. Do you want a bicycle? There's one for sale. That's the most important thing that makes money. All the other stuff follows that. It doesn't lead it. It follows that. And they've never established in crypto yet the basic currency function, which is insane. Like, when you think about how many billions have gone into this, just as an industry, and nobody's been focusing on how to make the currency work as currency, you start realizing that this is kind of the this is the inflation casino, where instead of inflating one currency or just a handful of reserve currencies, we're inflating the number of currencies. There's tens of thousands of coins.
Oh,
and
yeah.
It's
Stable
crazy.
coins right now are almost catching up with layer ones. It's like Oprah just decided to tell everyone in the audience that they can all have one. So now we have a layer one for you, a stable coin for you, a stable coin for you, a layer one for you. Do you want a layer two? We can have a layer two. And, so it goes on.
And there's no sound basis for it. Like, if they want to do that, the best model, and I mean, the best proof for this that we're going to have is when we show people how to do it and say, like, you can actually do this now, which is an associate chain model that's got the Gaju running natively adjacent to a local digitized, a Gajuized version
chain. Yeah.
on an associate chain. Then you can say, look, there's a digital yen and there's a digital Gaju next to each other, which means hopping over to the Canadian digital dollar is really easy because you only got one pass through, which is the Gaju. You go across Groot and you're over there now. Yay! That solves so many people that don't know how insane, and I didn't realize how crazy it was till we did some investigating in our team about how insane the financial, just the banking system in general works. Oh, and running into our own problems with trying to transfer things across borders and all that. Seeing how wacky and inefficient and just it's amazing anything happens at all without getting lost. Once the heroic efforts of the humans to correct screwed up systems is incredible.
I've been saying this since I was on a trade desk and I was throwing tickets. I would do the transaction on the computer, write a ticket, and throw the ticket in the bin, as it was called. And I did something that front office people are generally told not to do, to actually speak to the back office people like they're human beings. So the guy came around at the end of the day and he was collecting the bin and basically emptying all the tickets into his bin. And I said, so what actually happens with that? And from there began my voyage into understanding that the only thing that's systemic about the financial system is risk, and that the only reason it works is because people like the guy who was collecting the tickets go above and beyond. In fact, despite the system that they're operating in, they manage to make pretty much all the transactions match up and tally. And, you see this with banks when you start talking to them about their tech stack. I still remember the guy from IBM who showed me confidentially, and I'm not going to say which bank, but a bank that he was working with, how many different systems were polled in order for somebody to log into their online account and check their balance. And the answer was 27. And when he started to inquire how and why that was the case, they kept pointing at black boxes of code that was done 10 years ago, 20 years ago, and they didn't know what it does, but don't touch it because it does something. And the people who built that software are now retired. The people who specified what it should do are also retired, and you're stuck in this situation where, and this is, I've been writing a lot of off to one side for investors about the difference between blockchain and fintech, and explaining that fintech is really the process of making the inefficient marginally incrementally more efficient. This is digitization. Digitalization, such as Bitcoin promised and the Gajumaru makes possible, is to remove those inefficiencies altogether, by which we mean those rent-seeking intermediaries whose only function really is to control and tax your trade.
It's not that all of this happening on top of, as you mentioned, it's the blood of these peasants that grease the gears in the everything is fake economy. And the amount of fakeness, there was once a tremendous amount of value in the first world that took a long time to generate, and the systems that generate it are themselves a valuable subset of value itself. All that's kind of been milked dry, sucked of its marrow by the inflation part. And Milton Friedman, I think, collapsed this down to the most comprehensible statement possible, which is, it doesn't matter what the tax rate is at all. It doesn't matter what the overheads are at all. None of this matters. The only number that you really have to track to figure out if you're getting ahead or behind nationally is seeing how much your government's spending. Because anything they're spending above their income is the invisible inflation. Because they're not going to default until everything is so retarded that it's just kind of a collapse moment. So how quickly are you accelerating to that? You have to look at your deficit numbers. And that's, again, they're not going to default. So that money came out somehow. The government, when they deficit spend, they do spend. The money goes out somewhere. So it enters the economy somewhere. It's not like it's just, we'll pay it back later. Well, maybe they'll pay it back later, but that's not the point. The point is the pool in circulation just went up every time they deficit spend. And that's an additional magnifier on top of the published inflation number. And also the inflation number today, usually they make that out of like CPI stats or whatever, and that's not what inflation is.
No, as I say, that's what happens after inflation has passed through the reductive gearbox of destroying.
Right, started actually hitting people,
value.
And they're like, "Whoa, I have to change prices, or I'm going to go out of business." So then the prices go up, and now people have been programmed falsely through the little. So there's a thing that we call the implicit context switch, ICW, or ICS. The implicit context switch is that the meaning of a word that's really important or politically a hot button potentially, you change the meaning of it subtly, and you abuse the word enough to where people start not realizing what it really means. So inflation is an increase in the money supply. Price changes are a related but independent phenomenon. And this is a really big problem where people think that inflation is price increases. That's not actually what it is. You could dump 10% more money into the economy. That would be inflating the money supply. At the same time, if you overproduced by 20%, you've actually beaten inflation on production. So prices wouldn't change in a bad direction for you.
There are so many ways this plays out. There's a company called Cadbury, who are one of the Quaker, big Quaker companies from the UK. I think you have Hershey's in the States as another one. And they have a long-standing, very good business making chocolate. And they sold that to Philip Morris. Sorry, not Philip Morris. Philip Morris's sacrifice to pay the bill for having lied about cancer, which was called Kraft Foods, run by the same people with the same morals. And what Kraft Foods did is they bought Cadbury. And this is about how the corporatism game works a little bit. So it's a bit of a sidetrack, but I'll come back to it. I argued at the time to everybody who'd listen that you should take a Cadbury bar, which is a really good quality chocolate bar, and find some way of holding it in time, literally like in a vacuum or something. Because if you open that 10 years from now, it will taste completely different from the new one and the current one. And the reason will be that sugar is much cheaper than cocoa butter. So the sugar content will go up, the cocoa butter content will go down, and it will not be the same chocolate bar that it was, but the change will be so incremental, you won't notice it. It's like when I go back to Switzerland for a while and I come back and see my family, I do notice that my sons are getting taller. Whereas if I'm here all the time, I don't see it. It's incremental.
Mm-hmm.
Now, the thing that you then see in inflation, and this is where it gets funny, because the sweet manufacturers have recognized that people are kind of getting, but hold on, that was a euro a year ago. Why is it 150 now? So they did something really clever. They just shrunk the size of the item that you get. So now you're still buying a chocolate bar. And by the way, they put this under trying to attack diabetes and all that kind of virtue signaling. But fundamentally,
we're helping you.
Fundamentally, it's a 50% smaller bar for the same price as it was last year. And this is the kind of thing that's going on all the time. And as a fat person, I'm very aware of this. I remember when there was a 4-pack of Cadbury's bars, and it was 4 for €2, and they used to be actual bars. Now they're like mini bars, and it just doesn't have that same sense of fullness and guilt when you monster an entire packet of them.
Why do I eat this and only hate myself half as much?
Yeah,
This is
So-
weird.
like that, yeah.
But
So-
I mean,
but
one
this
thing
kind of
about the
inflation is
incrementalism
everywhere.
is
It's everywhere.
Yeah.
This is happening everywhere, across the board, except for cars. Cars are getting bigger, but everything else is getting smaller in order to avoid the actual price increase.
We got to make
And I
Ozempic
think-
for cars.
So I think one of the effects is that there is this more or less continuous feeling that the system keeps working. I mean, one of the things about COVID, for example, was I think a lot of people got a little bit surprised that, well, it didn't hurt the economy that much. Like the 2008 crisis also seemed like things bounced back reasonably quickly, and things were going fairly well.
Don't look
Now,
under
if you're looking behind the curtains, you would see that, well, the reason why it was kind of working was that we suddenly had negative interest, and the economy was just being continuously doped to keep up the appearances that it was still going well. The 9/11 attack was supposed to essentially collapse Wall Street. That didn't happen. And I guess a lot of people felt that, ooh, cool. That was probably a good thing. Now, the people who were in charge of staying on top of risk were not so cool about it because they didn't know what the hell just happened. It was a strong signal that they no longer had a grip on their exposure, and that they had to try to secretly figure out how they could claw back control before the next crash, which they knew was coming because the subprime loans in the real estate market in the U.S. was heading for a crash. It was a given, and everyone knew about it. But you don't want to talk about it because that will accelerate the dynamic that you're trying to prepare for. So, as a Swede, I feel that this feels very familiar because we are a strong consensus culture. So basically what you see in Sweden is that everyone seems to be in agreement on various things. Like things are going really well until they're not, and then everyone shifts at once. And nobody remembers or wants to talk about what their opinions were last year, because suddenly everyone is in new agreement. And this is essentially this happens in some kind of secret synchronization. Like people feel when it's time to switch their opinions to the new ones that now become the consensus. And so, for example,
Always been at war with East Asia.
Yeah, we've so we've talked about things that essentially threaten proof of work for Bitcoin. Like the fact that halving means that you're not getting rewarded as much for just producing a block. You're supposed to get rewards for fees, but there is no traffic on the Bitcoin chain, so you don't get compensated through increase of traffic, which was the original thinking behind this. And also we have the fact that AI really is offering huge competition against plain proof of work mining. So, for example, Elon Musk has, what was it, Grok 4? They had 200,000 GPUs doing the training for Grok 4. So if you're in the business of renting out your GPU capacity, why not do it for AI? It's probably going to pay better than Bitcoin mining.
Not only will it pay better, but nobody will complain that you're burning energy resources, because doing cat pictures and internet searches is apparently much more valuable than money.
Yes. But the interesting thing is that somehow the appearance is kept up that this is still fine, and Bitcoin is doing well, and the price is going up, and that can no longer be a case of intrinsic profitability, because we see how that isn't materializing. So then profitability has shifted to being something else. Kind of like when social media companies offer you services for free, you know that you are the product.
It's fundamentally this. What Bitcoin is becoming is a little bit like gold bars in an argument, which is that they just go into storage and they never move, and you never trade in the thing, you trade in the intermediation of that thing. Which is really just accepting that we're just going to rearrange the deck chairs on the Titanic, as opposed to actually think about how we're going to avoid this iceberg and do something better. The whole thing with the meme pool is interesting. Oh, sorry, the meme pool, forgive me. The mempool is very interesting because, ultimately, once nobody really supports mining Bitcoin, because doing anything becomes so expensive to do in terms of any energy consumption. I think Bitcoin power consumption is now the 24th. It's 24 in the list of list of countries. That if Bitcoin were a country, it would be 24 in the list of energy consumption. And a lot of that is wasteful. And we've talked about this before, that actually we had a potential investor who talked to us about how much efficiency there was in the chain relative to Bitcoin from an energy consumption perspective, and therefore CO2. Regardless of what you think about the whole man-made environmental warming argument, this is a thing that people have to contend with. And I inquired into it in quite some detail. And actually things like defensive mining become really relevant. The speed of settlement become relevant because the amount of wasteful computational capacity is huge. But when we look at what's happening with the mempool in Bitcoin, you're seeing what potentially becomes the end of it being mined, the end of it really existing as anything other than something that sits in storage as intermediation. And that is never what it was meant to be, or even close to it. Craig, just to come back to that, some time back when I was punishing you guys with lots of writing and making you look at all the lunacy that was going on in the world around us to see why, to really contextualize what we were doing, you were also writing the plan for how the Gajumaru works from an economic perspective. And one of the things that you were illustrating was that if we could make things work like Gaju Market, Gaju Markets, Gaju Pay, Gaju Me, etc., pretty quickly it would get to the point where confirming transactions became more profitable than mining. Just take people through that a little bit to bring us home on this.
Right. So so what that split is the difference between the block reward, which is the minting of new Gajus with each key block, which is how Gajus come into existence, is it follows this mining curve over time. which is quite long. It's like 87 years or something. It'll probably be perpetual though, because of the reclamation function where things don't actually get burned forever. They can be burned for like 20 years. Um, so there'll always be some gajus being mined freshly. However, at some point that amount goes to, I mean, the mining curve is fairly aggressive because we know that we have markets that we want to push money out to. It follows the Fibonacci curve, so it's a pretty sharp cut after the first couple years, or within the first several years, to try to get as much into distribution as possible into circulation. However, as a miner, the thing that you start looking at is you don't care about the block reward as much as the transaction fee component. And even though we can handle a ton of transactions per second, at some point when you look at retail transactions that are like at a common cash level, a couple of bucks here, a couple of bucks here, a couple of gajus here, a couple of gajus there, that kind of thing, that level, that number of transactions globally could there's no system in the world that can remain consistent and handle all of that. So this idea of the mempool being a contentious environment where to get your transactions processed, you're willing to pay more than the other guy to compete on price, that makes the block rewards become less valuable pretty quickly than the expected transaction fee sum for a given generation. Somewhere in there is a pricing function that will pressure retail transactions onto associate chains if regulation does not do that first. So you wind up having Groot becoming an interchange point where people move money across chains through Groot, maybe in bulk, and to them paying a really high transaction fee to move a large sum of money across Groot from one chain to another. That wouldn't bother you at all if the transaction fee is like relatively expensive, but you're moving a bunch of money. You're not doing a retail trend. If I buy a cheeseburger for five gajus, and the transaction fee is 2 gajus, that's silly. I'm not gonna pay that. I'll go to an associate chain and pay like a tiny fraction of that cost to have the transaction process over there. But then when I go on vacation and I'm moving jurisdiction, so maybe the associate chain that operates in my jurisdiction has its transaction fees or whatever they are, but I'm going to go take vacation in the US or something. I'm going to move money over to an American regulated associate chain to continue to enjoy low fees over there. That movement across Groot is going to have a single transaction fee associated with it that may be relatively high. It might be like 3 or 10 gajus. I don't know. It could be 3 gajus. I'd be willing to do that, to transfer 1,000 gajus over there. That wouldn't bother me at all. But the point being that the aggregate of transaction fees that will happen on Groot there will always be some price pressure there to keep transaction fees high, and they may become quite high at some point, which again, that's part of the natural kind of evolution of the system into these different chains that handle different sub-jurisdictions and so on, with Groot maintaining the securing the mint function of the overall ecosystem as a whole. And that leads into the whole, like, why is the Gajumaru called the Gajumaru? It's got this crazy kind of branching structure to it that will evolve over time. But those pricing functions in the mempool that make transaction fees in aggregate likely worth much more over time than the block reward, that will keep mining attractive, in addition to this aspect of, if you have even just a graphics card that's idle and you keep it running, it's like running an incandescent light bulb all day. That defensive mining aspect, if you're willing to pay that for defensive mining, it's also kind of a lottery ticket. There is a chance you legitimately might win. You'd get a big dump of gajus. Maybe you could close your shop then and not care anymore about it because you'd won the lottery. But the defensive mining aspect, combined with the fact that there is a financial incentive to continue mining on Groot over time, even as things evolve into this kind of exploding, multiply connected network web of different chains talking to each other, that's got a future and that's got legs. The Bitcoin model that we're seeing right now, that chart with the transaction fees dropping precipitously like that really makes me wonder if like at after the next halving, is anyone going to mine? I don't know. It just seems kind of like whoa.
The
And it
argument
undermines
is
the
about
whole
price. Go on, Jarvis.
undermines the whole argument that Bitcoin is a settlement layer because
Yeah.
no one's settling anything on it anymore. Everyone's trusting custodians to deal with it. Whereas the prospect of Gajumaru is you can settle things on it. And if that ever stops being possible, by then people will be spending even more money on essentially an alternative to the current almost extortionate wire system that we have, that where instead of giving huge amounts of money to middlemen as they cross money from bank to bank, you're paying for the actual security of a real hard money digital currency. It's a totally different prospect. It sounds like what the Bitcoin maximalists, as they're sometimes called, claim is how Bitcoin's supposed to work. Meanwhile, the mempool is becoming empty with time.
Well, there's no incentive to use it.
So the price of the transaction fees should be dropping, should be compared to the cost per transaction on Bitcoin, which currently is about $115 and reached a top level on August 3rd, $196 almost.
So for the bargain amount of $196, you could buy tomatoes, to return to the theme of the spa in Switzerland. For the princely sum of $196, you could buy a bag of tomatoes in the store.
Yes.
Well, you could process the payment.
So again,
that chart's wild though. That's like I sense a divergence in the force. Like something's not going right.
Yeah. So obviously, if like in normal retail terms, if you are losing money on every transaction, then either you're going out of business, or what you're doing is what's called a loss leader. Is that you accept that you will be losing money on this particular product because you are making money some other way. But clearly it's not the transaction fees covering this cost. It is something else. Or
so
the system is going down. So
you have a combination of extraordinarily high cost to transact, leading to an extraordinarily empty mempool. Craig.
Yes.
So there's a strange dynamic here where, because there was never a roadmap for, I mean, again, it gets back to Bitcoin being like a proof of concept that sort of took on a life of its own. But because we have a roadmap for associate chains operating in very different ways from Groot, and Groot really narrowing down to the mint protection function over time, institutional adoption just continues to drive the future growth of different roots and subtrees of the Gajumaru. Whereas it seems like institutional adoption with Bitcoin, that might be kind of the anvil that's going to break the camel's back. And I don't know what happens to that. Because institutional adoption here has led to, well, as you mentioned before, the bag holding problem, where ETFs are a massive way to juice
Industrialization of bag holding. Yep.
Yeah, industrialization of bag holding. But that's become the game, not defending the chain and not transacting on chain, to such a degree that nobody is transacting on chain now. And nobody transacting on chain kills the mempool, that kills mining prospects, and then there's the core of the whole thing just doesn't, it's not a thing anymore.
So if you look at what Michael Saylor and MicroStrategy are trying to do, and he's very open about this, albeit that I think it's one of those things it's a little bit like Jeff Bezos saying that your margin is my profit, and Larry Fink saying that we can change the hard cap of Bitcoin. It's the quiet bit said out loud that they probably didn't mean to say. But he did say that his objective was effectively to turn MicroStrategy into a central bank. So he is issuing dollars on the back of their Bitcoin. And this is the argument that's being played out. I can see it happening. Essentially, the idea is that I've got all the digital gold, and as long as everyone continues to believe that this is digital gold, despite the fact that you can't trade in it, you can't do anything with it, you literally just keep it on storage and have an intermediated relationship with it, then people can then say, oh, well, I'm going to issue dollars against this, which goes back to JP Morgan's testimony to Congress in 1912, where he very accurately described the difference between the greenback, which would be the Graeber version of all money is debt, versus the dollar, or as he pointed out, the pound, as it then was one-to-one backed by gold, and you could believe that the Bank of England had it, but you had to trust the Bank of England, that they were telling the truth, and that their audited gold reserves were correct, and that the amount of pounds in circulation accurately matched the gold reserves.
I guess what bothers me
I'm reminded of how the talk about auditing Fort Knox, the gold reserve there, it kind of just died out. Why would you want to do that?
A bunch of nowhere. That got kicked straight in the memory hole.
Vast amounts of gold being transferred on commercial aircraft with people in their personal luggage. Yes.
So, I guess the sort of chaotic potential is, we discussed defensive mining in this conversation already. It would seem that there's a massive incentive for all the institutional stakeholders in Bitcoin now to be doing defensive mining. That doesn't seem to be the case, given that the situation with like the 5 top wallets, and especially the top 2, or the top 2 mining accounts rather, having not changed since institutional adoption, means that it doesn't seem like these institutional adopters have stood up massive mining operations to secure the chain. What happens when the mining power just drops all of a sudden on Bitcoin? Do we care what's on chain, or do we start trusting these off-chain ledgers and like lock it at some point and say, well, Bitcoin was a living thing up until here, and from now we're just going to trust all these locked, we're going to like pick a certain height.
That's exactly what they want you to do, Craig. That's exactly what they want you to do. So it's essentially the king is dead, long live the king.
Right.
So the intermediated fractionalized banking system is dead. Now it's back again, and this time it's going to be about stable coins and reference coins. And reference coins are going to be a dollar or a different type of currency that is rooted to a Bitcoin. And essentially, you're going to trust MicroStrategy to say, we pinky promise we have it. And we haven't rehypothecated it.
That's ephemerally locked in a dead blockchain that's got a capped height that can't ever be mined anymore seems the diametric opposite of what Nakamoto Satoshi was like even making his paper about, right? But that's where
I love it when you talk Japanese to me. It's
that's just the guy's name.
No, I know. It's just, the thing that always makes me laugh with you is you've got this very masculine Texan voice most of the time until you speak Japanese, and then the whole pitch of your voice changes. It's like a different person is speaking. Whereas I think when I speak my terrible German, people, apart from the fact my German is terrible, people are quite aware that my base language is English. But with you, you actually literally switch tonality, everything when you say anything in Japanese. It still tickles me 3 years on.
I will have to.
But the difference is German is much more fitting of your authentic personality, Greg.
I'm not sure that's a compliment, but
I'll do it. I'll do a whole video, like explaining something about how blockchain works, and I'll do it in Japanese. But I'm gonna, instead of saying like, I don't know, Shingijutsu no setsume suru no wa, blah, blah, blah. So I'll be like, Shingijutsu no setsume suru no wa. Like, just kind of make everybody who watches it confused.
Yeah, that'll be good. Look, to bring this home, we opened up talking about Monero being attacked by Qubic. Qubic have now moved on allegedly to Dogecoin, and the question about whether proof of work chains remain viable in the face of that kind of computational power being directed toward them. The question that we've asked as well is, well, if you look at what's happening with Bitcoin, the transition very clearly for a lot of these miners is to move away from speculative number go up coins, or in the case of Bitcoin, into something that's almost dying from a transactional perspective, an empty mempool with a very expensive transactional cost. $196, Ulf said. I think you said 114 currently. Am I right?
Mm-hmm.
This is completely ridiculous, and in a sense, you might argue that what Qubic are doing is exposing the realities of that stupidity. Now, they don't have the capacity to go after Bitcoin because that would require vast amounts of computational capacity for them to play the same game. But it is a cautionary tale that they started off with a relatively small amount of the mining capacity and then created incentives to get them to 35. And the interesting thing is they didn't need to get to 51.
But the thing with the Bitcoin mining that I'm kind of thinking through in my head, though, is that if the miners are being selfish miners and they've got a profit motive instead of a defensive one or even an altruistic one, then, the Ponzi's can build for a long time over time, but they crash all at once. It's, you inflate the bubble and then it pops, right? It doesn't like slowly deflate and it's a graceful transition to something else. Stuff goes like you build stuff, then it looks like shark teeth always. And
Yeah.
So what happens when Bitcoin just like people go, well, actually this sucks now, bye. That
It's Jenga. I explained financial markets to my son a few years back using Jenga. And I said, that the object of Jenga is to always have somebody else take your trade. And in financial markets, you never want to be the person who catches the peak or the trough. You always want to be the guy who had somebody else to pass that risk on to. Take your profit and cash it in. Exit your risk. I always used to say that when I was developing systems for financial market trading, that I wanted to know three things: the moment, locus, and quantum of risk. And once I understood those things, I knew what the correct price points were to act and transact. And the moment that risk began to spike, I wanted out of the transaction because it was no longer profitable from my perspective relative to the risk that was then being taken. And Jenga is a similar thing. You keep pulling out blocks until the thing becomes so unstable that the next guy is the one who's going to lose. And that's, to your point about Ponzi schemes, it's not just Ponzi schemes, it's financial markets, it's everything. Everything works in a similar way. Once people begin to act in a way that undermines the structural strength, the structural integrity of the marketplace that they're operating in, the thing that they're doing, or in that case, Jenga, because your object in Jenga is to make it unstable, and that is how you win. Well, actually, that's similar to how everything else works too. So you get that point where somebody is left with the collapse. And I don't know what the future value of Bitcoin is. And I don't think anybody really does. There's lots of people producing total nonsense analysis around it. And it's really stick your finger in the air and guess. Does it have a value intrinsically? I don't know. But I do have a sense that where we are now and where we may be in a year's time, if Larry Fink's prediction of $600,000 or $700,000 for one Bitcoin becomes true, and with the amount of money printing that's going on in America, that's not so very far away.
Maybe that's the outlet to put it in. I don't know.
Yeah, but it's
that's really what the stock market's been doing. everything dumb keeps going up, but that's institutions that are getting flooded with money that's too cheap going, well,
So,
we'll put it over here.
so the way Bitcoin is produced right now, if the price of Bitcoin is supposed to reach that level, um, the whole dynamic will have to change, because it's already the case that producing a block in Bitcoin costs over $100,000. So it's almost as expensive as the price of a Bitcoin. Now that also means at that level of cost, it's only profitable to mine in areas of the world where the electricity price is low enough. Now, the electricity price will go up if the electrification that the Greens want will start accelerating, but also will be driven up by AI farms until we get fusion to work.
But hold on, to be fair, like I pointed out in Davos, it was absolutely fine that we divert entire river systems in order to cool AI server farms. What's not okay is doing anything else. That's the one thing that's okay, which ironically would be the one thing that potentially could lead to vast numbers of people being turned into dependents if they're not already. Forgive me for my slight skepticism around this, but you are hitting something real.
That makes
But
it
of
okay.
course, but if you can
what he's saying
artificially
is
drive the
there's
price
an
of
interesting-
Bitcoin up, then you can keep mining profitable. But it's
that's
not
the
the
game.
intrinsic. Yes.
That's the game, Ulf, is to keep the number go up going until so much gets sucked into it that it's too big to fail. Back to that privatization of profit and socialization of risk. And to your point, what's happening that we're seeing with the fall off in the mempool, the huge spike in cost to transact, these are all things that are essentially invalidating it. But let's not talk about Bitcoin to close. To close this out, Craig, I'm going to go back to you. Money, what is it? Why does something being money make a chain secure?
So money, just ask like this big philosophical question. Money, the money itself is any medium that's easily divisible that we just agree to transact in, because it's very hard without using an intermediary marker of value to do things like buy a basketball with cows. I want one basketball, but I make cows. That's my job. I make cows. Well, how do you buy one basketball with a cow? You don't. You have to figure out some other way, some way to intermediate that trade, so you've got a common sense of value. The reason money has value, so let me think of a good way to state this. The value of money itself is a belief in the future value of that money, which is an index of the shared faith that we have in that money. Now, does that sound self-referential? Well, it is. Most money starts out with a utility value. That's why precious metals have been such a go-to for money over the course of history. But the fact that money is self-referential but comes from metals which have other uses makes those uses outrageously expensive, because the monetary value of the metal winds up completely overshadowing whatever its utility value is. So computer chips cost a completely different amount to make right now than they normally would, because gold is also an index of money, a universal kind of money. So the fact that money is self-referential makes cryptocurrency a really good candidate, because cryptocurrency itself is self-referential. So what is a Gaju? A Gaju points to itself. It is a Gaju. The fact that you can't fake it, that's the utility. That's where you get the faith function from, that we can all agree that it's very, very hard, practically impossible to fake a Gaju. That's why we can have faith in it going forward in the future. all money is based on a promise in the future. All monetary function is essentially borrowing against everyone's shared belief of what happens in the future. That I believe I won't get cheated, that I think that the sun's going to come up tomorrow. And none of that stuff matters if the world's going to end right now. So our concept that there will be a future and that future is productive, that makes money even worth thinking about at all. So anyway, it's the shared faith concept that makes trading in a medium like money reasonable at all. We do have a whole set of academic papers on this. We have our own take on it, and so on. We should probably link those from our site somewhere. But the idea boils down to social faith, that you share the ideal that that money is going to have a value in the future. That's why inflation does unpredictable things to prices, because when you inflate the money supply quickly, but it doesn't hit the practical economy very quickly, if people hear about the inflation early, they may raise prices just because they heard about it, not because their local economy is actually affected yet, because their belief in the future value of that money has already changed, so the prices now change with the change in that faith. If, however, you inflate a lot, don't necessarily tell anybody about it, it's not a big public thing, people aren't thinking about it much, it may stay relatively contained in institutional pricing for quite a while, which is what we've seen. And that's the whole basis of the Cantillon effect, or Cantillon. I'm not sure how it's pronounced. But anyway, that effect where the people that are closest to the source of inflation benefit from it the most before prices have changed in the broader economy. And that's why price changes and inflation are not the same phenomenon. But the powers that be love tricking people about what that actually means. Anyway, money, the value of money is all based on shared faith. And in this discussion, we have touched on a lot of troubling indicators about the potential future faith value of a lot of existing currencies, not just, we've mentioned Bitcoin a fair amount here, but I guess that's because that's kind of that's the headline name everybody knows. And that's the one that ETFs and all that stuff have been built around. But the implication for a whole rack of other currencies comes up with that, because especially the ones that can't be used as money directly, easily transactable. That's one of the requirements for something to be considered money. And the existing cryptocurrencies certainly don't have that. Until somebody solves the I can buy a pair of shoes online with this directly on chain problem, crypto won't be money. And that's been our whole quest here. I mean, that's how I started my quest into cryptocurrency, was that exactly. So I'm really glad
one thing you mentioned, that the Gaju can't be faked. This is true as long as you are transacting on chain.
Ooh, yeah. So yeah, and that's the issue with these the pinky swear off-chain ledger stuff. How much Bitcoin's in circulation versus how much has actually been minted on chain? That's the shrug emoji. Nobody knows, and
which was the whole thing about the FTX.
Yeah, that's right. So the incentive to cheat that is huge. So if the incentive to cheat is gigantic, and the penalty for cheating is like 0 or near 0, then someone's going to be cheating. And it's hard to not see that that's the situation right now with a lot of things.
Yeah. So our mission has been to make the Gajumaru a blockchain that can actually work as real money. But that means that there are a lot of practical problems that you have to solve. And I guess this is the big contrast between the other chains, where essentially the value of the coin is the business case, and it doesn't really matter if people transact on chain or not, as long as the price of the coin is determined by other forces. Now, And so back to the safety against these brute force attacks, for example. A lot of the witnessing, the finality constructs, the associate chains, the techniques to anchor chains in a legal space so that you can actually be compatible with regulation. All these things serve to make Gaju usable as money. And they all play into how the chain and the coin can be safe, and which is also the basis for defensive mining, because you can actually do things that are valuable to you on chain, which provides an incentive to actually invest in doing honest mining for the sake of securing the chain. Not just for fanatics, but for people who actually are in business, which is fairly special.
For us to make money off of Gaju market is going to require people to actually do transactions on chain, because we're aiming to, capture a market fee from that, and that's not the same thing as writing the price up. Because Groot doesn't have an operator. That's
to close this out.
That's
something that we're going to come to. So we're trying to get millions of people mining the Gajumaru. We've created software as a service that makes it possible for them to install that on most machines. Obviously, something that you've left in your cupboard from the 1990s may not be so useful, but on most machines, and hopefully get millions of people participating in the mining, which then means that millions of people have Gajus. We don't want to play the Scrooge McDuck thing here and just take everything into ourselves. We want the whole world to be part of this. And as that happens, you're going to get more and more people who will naturally use these markets because they have Gajus and they understand what the value of the whole system is. So one of the first things we want to do once we have Gaju market running with mainnet later this year is have all of our miners come in and use it. And what we're going to ask people to do is to commit to selling a t-shirt, a cap, a piano, whatever it is, through Gaju market, and actually show people this is live, this is real, and this is something you can really do. And that egregious taxation of platform control and, as I put it, toll bridge trolls is now, the days are numbered, if not done. And with that, thank you all for your time today. We'll talk to you again next week. Bye-bye.